Hey, you want to hear a secret?
A secret? What secret?
This secret has helped many people become financially free. It's what the wealthy use to purchase their investments so they can multiply their returns.
Multiply?
Yes, multiply. Want to know what it is?
Duh.
The secret is opium.
Opium?
Not opium, OPM, as in other people's money. Specifically, we're talking about debt.
Psh, debt? Like getting a loan from the bank?
Yep, debt.
Huh? How can debt help you create wealth?
Well, watch on, little baby man, and I will show you. Hey there, what's going on? This is Matt Maupin. I'm the founder of the Passive Wealth Investors Club, and today we're going to be talking about one of the most powerful tools of the wealthy. It's called financial leverage. But before we get started, go ahead and hit that like button below, and if you haven't already, go ahead and subscribe to our channel and help us grow so we can continue to bring you fresh content. Now, I should probably start off by addressing the elephant in the room. And that is this. A lot of us have been taught that debt is bad. You know, Dave Ramsey makes a pretty good living telling people that debt is bad. And maybe that could be a really good advice for some people, depending on their goals. If your goal is to become debt-free and pay off your house and maybe become a successful middle-of-the-road American, being debt-free can be a rewarding accomplishment. But if you're looking to become financially free, you may want to consider another point of view before you go all in on the debt-free idea. Debt is a tool, and like a knife, if you don't use it properly, you can hurt yourself. That's exactly why you never give a 2-year-old a knife. But to say that all debt is bad is like saying knives are bad or guns are bad. It's not the tool that's the problem. It's the lack of discipline and knowledge about how to properly use debt as a financial tool. That is the problem. Tools are just created to make things easier. Think about that the next time you're about to cut your ham sandwich in half. I know, that was pretty cheesy. Hey, speaking of ham and cheese and sandwiches, are you getting hungry? The fact is that wealthy people use debt much differently than the poor and the middle class. One example of poor use of debt is when people rack up a ton of credit card debt to finance a lifestyle they cannot afford. They see a credit card as free money and begin to purchase things without considering the cost or their ability to repay. The consequences of carrying a balance for a long time on a credit card and only making the minimum payment every month is a racket. Those who don't end up filing bankruptcy get stuck paying this debt for decades before they can ever get free from it. The amount of money they pay in interest is staggering. The consequences of being irresponsible for debt can be debilitating. The wealthy use credit cards in a completely different way. They use them to help track their spending and get free cash and other perks from the credit card company just for using them. Paying off the balance every month helps them avoid any finance charges and assists them in help building up their credit profile. As you can see, those that use credit cards properly are rewarded, while those who make poor decisions pay a penalty. Another blunder of the poor and middle class is borrowing as much money as they possibly can to purchase a vehicle. And while owning a decent car is a necessity for most folks, driving around in something that you can barely afford can be damaging to your finances, no matter how much it puffs up your ego. By allocating a large portion of their income to making a car payment, they really are handicapping themselves financially and increasing their risk of defaulting. Because cars can depreciate faster than the loan is paid down, many people owe more than what their vehicle's worth. And the racket here is when people decide to upgrade their vehicle every few years and then they roll that negative equity into the next car. They're increasing their liabilities at an increasing rate. Unfortunately, there are tons of people literally driving around their net worth, which in many cases is negative. I completely agree with paying off these sorts of debts as soon as possible. Staying in this kind of debt can really hamper your financial mobility. Ultimately, leverage helps you do more with less. Leverage magnifies financial outcomes. And this is why it's so important to be careful when using leverage. You really want to make sure that you are magnifying outcomes that benefit your financial statement instead of harming it.
What are some examples of good debt?
Well, the wealthy use debt to buy assets, and specifically, they focus on assets that appreciate and generate income. The key to increasing your wealth and income is by buying as many of these wealth-building assets as possible. My favorite asset to buy provides enough cash flow from the asset to completely pay for the debt, and that's investment real estate. Real estate also appreciates over time. And so when you combine appreciation and cash flow with leverage into a relatively low risk asset, you hit the jackpot. And that's why real estate is such a huge part of our portfolio. I want to give you a quick example about how powerful leverage can be. All right, so here we are at Zillow, and I'm just going to pull up a rental property of mine and just see what kind of leverage appreciation I've been able to build up just by owning it. I've actually owned this for about 18 years. Zillow only goes back 10, so we're going to just assume I bought it 10 years ago. And we're going to use this Zestimate here as the current value. I know that sometimes this is not very accurate. It's more accurate in different areas. This is actually pretty accurate for this particular property, but either way, not a big deal. It's going to be probably close enough generally speaking, to just get an idea of what leverage is doing. So assuming it's worth 740, let's see what it was worth 10 years ago. It was worth $259,000. So let's just call it 260. Let's just say I didn't even get a deal on this house. I paid, market price for this property, and we're just buying it as a rental. And I put 20% down. That's going to be a down payment of $52,000, and I'm going to get a loan for $208,000. And again, we're just going to assume I bought this, held it as a rental, and that the rental income was used to pay for the mortgage. And it did provide additional cash flow. We're not going to put that into this calculation. We're just looking at the equity growth. So now today it's worth $740. So if I still have a loan for $208,000, assuming I didn't do any cash out refinancing, again, I just bought this and held it and rented it out. I owe $208 still. That leaves us with $532,000 of equity. So basically, we turned a $52,000 down payment into $532,000 of equity in 10 years. So 532, divide that by 52. That means we multiplied our down payment over 10 times in 10 years. That's basically, let's look at the annual. It's over basically doubling our down payment every year on average for the last 10 years. Now, this does not even include any of the cash flow from the property. It doesn't include any of the tax benefits of the depreciation, reducing our income taxes. It doesn't even include any of the loan amortization, which is another $41,000. So over those 10 years, we paid that load down from $208 to around $166,000, $167,000. So there's another $41,000 of additional equity building up just by using the tenant's rent to pay down the loan. Now, let's look at the unleveraged equity growth with that same property. The only thing that changes here is the amount of cash we're using to control the same deal. Once again, our purchase price is $260,000, but in this case, we will need the full $260,000 of cash, which is 5 times the amount of money. If we turn that $260,000 into $740,000, we have multiplied our investment 2.85 times and generated an average annual equity growth of 28%. In this case, the cash flow will be quite a bit higher when you're not using debt to leverage, but the additional cash flow is not going to move that 28% average anywhere close to the 102% that you're getting by leveraging. Now, for those who recognize the last 10 years have been quite irregular with asset values and want to look at longer time frames, or those who still think investing in the stock market is where it's at, let's take a look at the values from the point when the original home was built and sold. And so the county records show this home was originally purchased for $46,500 at the end of May 1975. At that time, the S&P was valued at $519. Since that time, the value of the home has increased 15.9 times over the original purchase price, averaging 34% per year. Now, over that same time period, the S&P has only gone up 7.2 times, which averages out at 15% per year. And don't forget, investment real estate also provides cash flow and tax benefits that are not available to stock investors. Now, if you want to dig deeper into the stocks versus real estate debate, I suggest you take a look at a white paper written by the San Francisco branch of the Federal Reserve called The Rate of Return on Everything, 1870 through 2015. And it's a 120-page investigative report. And in that report, it states that we find that real estate, not stocks or equities, has been the best long-run investment over the course of modern history. That's on page 12. It goes on to later state that the volatility for real estate is substantially lower than equities or stocks. Clearly, real estate is a better performing investment over the long period. So a few things you want to look out for when using debt. The first thing is the leverage ratio. Big thing is you don't want to over leverage because too much debt can make any investment risky. The second thing you're going to want to pay attention to is the term of the financing and make sure it's in alignment with the time frame of your investment. As a side note, if you're going to be using bridge financing to stabilize an asset before getting permanent financing, just make sure you consider the risk of potential interest rate creep of the permanent financing when you're underwriting the deal. Third thing you're going to want to look at is whether the lender is requiring a personal guarantee. I would say if you can avoid that, you should always try to avoid that. Fourth thing you want to look at is the volatility of the asset being financed. Assets with high standard deviations shouldn't be leveraged, in my opinion, because the risk of default is too great. I personally gotten burned doing some margin plays on Wall Street. I learned this lesson the hard way, so just would recommend not using highly volatile assets when using leverage. The fifth thing you're going to want to be looking at is, if you're going to be using debt in combination with a retirement account for investing, there's going to be some special tax implications to consider, and you should definitely talk with your CPA before proceeding with any kind of investment like this. The sixth thing is taking a look at the debt arbitrage effect on cash flow. Here you're going to be looking at the interest rate paid versus the cash flow earned. Generally speaking, it just doesn't make sense to borrow at, say, a rate of 5 and invest in something that is projected to yield maybe 3% cash on cash, unless you can handle the negative cash flow and there's some sort of larger upside that makes the negative cash flow worthwhile. I personally don't like doing this, but there are some out there. Just make sure you're looking at that before you proceed. The seventh thing, the last thing, is you want to make sure you're getting positive leverage. Take a look at the interest rate versus the capitalization rate of the asset, and you want to make sure that the cap rate is higher than your interest. Once again, there are some people that look at maybe the large back end of a deal and they think maybe it's worth considering the negative cash flow, the negative leverage, but it definitely adds a degree of risk to the deal. These are things you definitely want to be paying attention to. Here are a few advantages of using debt. The first thing you can do is advanced investors, they use debt to revive otherwise dead equity. And what I mean by that is if you look at your return on equity, say you have a property, it's got a bunch of equity and it's just not performing well, maybe it's going up with the market, but the more equity you have, the lower your yield on that equity will be. So you can use debt to extract that equity, and then you can do a few things with it. The first thing you can do is just use it as income. We're not taxed on loans, and so assuming your investment pays the interest and all that, you can use that money as income, and it's tax-free income to you. The second thing you can do is just recover your cash, or basically recapitalize all of your investment out of the investment, and you're basically removing the risk to that capital from the deal. So if something goes south down the road, you really don't have any money in that deal anymore, and you can walk away scot-free other than wasting your time and some other things. The third thing you can do is you can redeploy that capital into another investment, and basically this adds velocity. So you're taking that same money, put into a deal, you let it grow up, you pull that money out, then you put it into a next deal, and that same money is getting used in multiple deals, and that's adding velocity to your investing. So, if you look at interest rates and inflation, we're kind of in this weird phenomenon. This doesn't happen very often, but inflation, let's say, they say it's around 8, it could be higher, but if you're borrowing at a rate of 4 and buying something that's going up at the rate of inflation or more, you're paying 4%, you bought something that goes up at 8%, they're actually paying you to borrow that money, assuming you use it wisely. And this is how the wealthy use debt in a way that is financially beneficial to them. It's a lot different than the middle class and the poor use debt. So speaking of inflation, debt is a great way to short the dollar. So what do I mean by that? If you understand how the time value of money works, you know that today's dollars are worth more than tomorrow's dollars. And so when you leverage into investments, assuming these investments are also appreciating and providing cash flow, you're borrowing money today to purchase something that's going up in value over time, but you're paying that loan back with tomorrow's money, and that money is worth less. So because of this, inflation is actually one of the mechanisms that helps investors automatically increase their wealth. The last thing I want you to consider, especially this applies in investment real estate, if you're using fixed rate debt to purchase cash flowing assets such as real estate, and if that cash flow adjusts over time, like in investment real estate, rents go up over time, but your debt payment is fixed, what happens is your cash flow will automatically go up over time and will adjust for inflation and actually beat inflation because of the way you're leveraging. So the longer you own that asset, the more your cash flow grows. This is how the wealthy are using debt to their advantage. Hopefully I've given you a few ideas about different ways to think about debt. It's not all just bad. It's all about how you use it. It's just a tool. In summary, the wealthy use debt much differently than the poor and the middle class. Wealthy use debt as a financial leverage tool to increase their assets, while the poor and middle class only use debt to increase their liabilities. Appreciating and cash generating assets like real estate over long periods of time is a surefire way to become wealthy, especially when you're using financial leverage. You're going to increase your yield exponentially. It's no wonder why real estate investments has created 90% of all the millionaires. And I want to talk to you about within the Passive Wealth Investors Club, our members have access to thoroughly reviewed commercial real estate investments that use financial leverage to help them magnify their returns. What's great is our members get access to this leverage without ever having to worry about signing a loan because it's built right into the deal. If this sounds like something you'd like to learn more about, make sure to visit us at PassiveWealthInvestors.com and sign up to become a member of our club. Thanks for watching, and until next time, go out there and create some passive wealth and income.